Well, the Wall Street Journal's Media and Entertainment Bureau Chief, Amol Sharma, was the first to break this story, and he joins me now via Zoom. Amol, it's great to have you on the show. A $7 billion venture. What does it include?
Well, Kristen, you named a bunch of the cable networks that will be in this business. It's basically every cable channel that Comcast, NBC, Universal owns, with the exception of Bravo. Bravo will stay in the mothership at Comcast, NBC, and the main reason for that is that they found that there was a lot of overlap between the viewership of Bravo and the Peacock streaming service, and that is the future, streaming. So they wanted to keep Bravo in the fold, but everything else will go. You named many of the channels, also Sci-Fi, Oxygen. It's really cleaving off that entire business, almost all of it.
Walk us through the leadership changes that this entails.
Well, Mark Lazarus, who will be CEO of this new, as yet unnamed venture, he's a veteran of Comcast. He's worked in the sports media arena. He's been calling the shots on the TV business for several years. Very experienced. The view in the company is that they're putting a real steady hand on the wheel of this new cable company. He also, has done a lot of the core business functions that you'd need to do to run a cable TV operation. And he'll also take with him Anand Kini, who is a very experienced CFO at NBC and the head of strategy at Comcast, very respected in the company. And I think it's being taken as a signal, both by investors and people who work at Comcast, that this is a really serious venture with some hefty leadership atop it.
Amol, based on your reporting, why was now the time to do this?
I think Comcast said on its recent earnings call, which was on a Halloween, so maybe some people missed it, that it was studying this. But I think people were surprised at how quickly they moved between that time and actually announcing it. And I'm told that they've been working on this for many months. It's just, I think the timing is that you want to find the right point where investors are ready to sort of take this on as, there's something that's going to happen when this is cleaved off, where profits are going to go with it, right? These cable networks are still profitable. And you have to sort of sell to the investors that you can absorb all that and you can lose that profit. And Comcast is a big company with a very strong balance sheet. So they wanted to line up their ducks to make that case and do it in an orderly, managed way and make sure that the leadership pieces were in place as well. And I think that's what's been going on.
What does it mean for existing shareholders?
So this is structured as a tax-free spinoff to Comcast shareholders. So they will essentially own the spun-off company. They'll just have a clear look at it separate from the parent company. Over time, of course, it'll be a publicly traded company, so people can sell out of the stock and new investors can come in. But I think what it means is they'll get a clear look at what is still very profitable cable company that will reach around 70 million households across these channels. But of course, it's something that's not going to be growing. Cord cutting is going to keep taking a toll on subscriptions in cable and on viewership. And so they'll be able to evaluate the business as a short-term profit, long-term growth challenged operation.
And what can you tell us about the state of the business as it relates to cable networks, the streaming space, and the digital landscape?
There's two things to watch out for here. One is, I think this company is really going to have its best chance if it grows beyond what Comcast is putting into it. We've heard for years that there could be a roll-up of cable networks. Somebody could come in and take all these declining assets and put them together. And popular wisdom on that would be an Apollo or TPG or some combination of private equity. But Comcast sees this thing as a possible aggregator, so I think you look at whether maybe there's other channels across the cable dial that could wind up in this thing over time. And on the streaming side, look, the reason they're doing this is they want to focus, really purely on investing in streaming and in sports. And those are the things that are core to the mothership, to the parent company. And I think you see that across the sector too. That's what everybody wants to do. Not every company is in position to do a spinoff like this because they're not in the same financial position as Comcast, and some of them strategically don't want to, like Disney. But I think that those are some of the key dynamics here. Just it's all about streaming, and it's all about sports.
Amol, what happens from here?
I think with the Trump administration coming in and a new antitrust team coming in, we'll have to see how all of the things I just mentioned in terms of potential aggregation and M&A will play out under that regime. That will determine a lot of how big that company could get and how this deal moves forward. And I think you also want to see how companies like Warner Brothers Discovery react to this. Are there some networks that they would ultimately want to put into this venture, or would they want to do something similar? So I think there's just a lot of unanswered questions. Also, the NBC News operation is going to be split here. MSNBC would go into this venture, and that means that NBC News would sort of be cleaved, and also CNBC would go into this venture. So those things are pretty tied together now, and I think we'll wait to see what impact that has on the business, any lost efficiencies or scale benefits that come with being together at NBC Universal now. So that's another thing we'll look at.
Amol Sharma, great to get your take. Thank you so much for joining. Great to see you. Amol's the Wall Street Journal's Media and Entertainment Bureau Chief.